Hello, everybody, and welcome to this month's Newcastle Discover, which is the latest in our Discover series. My name's Lily Moore, and I am the Alumni Engagement Manager here at Newcastle University, and I'll be the host for today's event. As always, a massive thank you to everyone who's joining us here today. Before we dive into today's session, I'd like to let everyone know that this event is being recorded and it will be made available later to watch on our Newcastle Alumni's YouTube channel. So, moving on to the content of today's event, Money for Millennials, Managing Your Mindset and Mortgages. We're kickstarting the new year by learning how to better manage our personal finances. Money really does make the world go round, and therefore it makes sense to get to grips with some of the basics. Money and managing our finances can be a bit of a daunting prospect, with many of us feeling anxious and unsure about our current financial situation. We're delighted to be joined today by alumna Lyndsey Stephenson, who is going to offer some guidance around some of the important financial decisions we need to make in life, such as purchasing property, paying off debt, and budgeting. Lyndsey has been a mortgage and protection advisor since graduating from Newcastle University in 2004. She prides herself on extremely high standards of customer service and has loved creating valuable relationships with her clients over the years. She's also passionate about helping the younger generation plan for their future and how teaching people that small steps when you are younger can really help you financially when you're older. So without further ado, Lyndsey, over to you.
Thanks very much for that lovely introduction, Lily, and hello and welcome everybody to the presentation today. As Lily mentioned, it is a little bit wet and damp here in Newcastle. I am also in Newcastle, so it'll be great to hear from you to see where you are. I have got quite a lot of content to get through today, and we're obviously on a limited time frame, so I'm going to try and stick to a time frame and move on. Please do feel free to send in those questions, and I'll happily try and answer anything at the end of today's session. My contact details will also be shared. If you have anything that I haven't covered and we run out of time, you are more than welcome to get in touch, and I will see if I can help. So let's move on and go through what you can expect from the presentation today. So a couple of things I'm going to cover. I'm going to start with some quick wins. Mortgages, finance, money, everything can be really confusing. There's so much to take in, and if you go onto Google, it's like a minefield. So I'm going to start with some of the easy things that we probably all know about, but maybe don't do. And just some of us, it might be a little bit of a reminder. Some of you might think, actually, I never thought of it that way. I can change things going forward. So those quick wins, something you can do relatively easily, move on and build from there. We're then going to look at some budgeting. I'm going to look at savings because obviously it's a question that I get asked quite a lot, but I'm also going to look at what's better. Do we save? Do we pay off debt? Do we do a little bit of both? And also there is good debt and there is bad debt. So I'm going to talk you through some of those and then how to plan ahead into sort of goal setting for the future. And then I'm going to go into mortgages and protection near the end of the presentation today. If I'm honest, I could probably cover an hour and just touch on mortgages, but we haven't got that much time. So please bear with me as best as I can today. So moving on to some of the quick wins, I'm going to state some of the obvious things to start with. Most of us on the presentation today will have a bank account. You've probably had it since you were maybe a young child that then moved into a student account when you were at university, and on it goes. But when was the last time, realistically, you looked at that bank account and tried to find a bank account that works for you? There are lots and lots of different bank accounts. I'm not here to represent any one particular bank and say you should be going here, you should be going there, because it all depends on your individual needs, your circumstances, and ultimately what you want to achieve. So a couple of things to bear in mind, especially considering obviously the presentation is done on behalf of the university today. If you had a bank account while you're at university, most people get a student overdraft facility, which is great. It helps you all the way through university. I was there myself. I did it 20 years ago. But you need to think about what you do with that overdraft when you come to the end of your studying period. Trust me, bank accounts want their money, so they will quickly whack an interest charge on there if you don't pay back what you're supposed to be paying back. So think about it. Talk to other banks, look online, look at what you can do moving your bank account to another bank. Is there another bank that offers you an interest-free overdraft facility if you're still in your overdraft that takes you through once you are a graduate and maybe takes you through beyond that into the professional world of work? So again, don't pay interest where you don't need to be paying interest. There's also things to think about with bank accounts about switching your bank. If you've been with one of the main high street banks since you are 10 years old and never thought about switching, now could be the time. I had a quick look yesterday just to see which bank accounts were offering kind of the most cash back for switching between banks. You can make a massive £175 at the minute going over to someone like First Direct. That involves very little work from you. You apply for a bank account with them. They take on all of the switching. So they contact all of your providers that you've got direct debit set up with, and they switch them all to the new bank account. So they're doing all of the legwork for you. And to thank you for coming over, they'll give you £175. It's free cash. I know people who switch their bank accounts every year and a half, and some of them, well, one client of mine has racked up nearly £1,000 in free cash just physically from moving their bank account regularly. Now, yes, that does have a small credit check each time, but it is a very, very small credit check. And if you've got good credit, then yeah, it's something to think about. Can you make your bank account work in your favour, essentially? Another quick win, thinking about your financial future, is when was the last time you checked you were on the electoral roll? So this means whatever address you are registered at, you are actually registered there with the local authority as residing at that property. And the reason for that is it means you can be found. And I don't mean that in anything as it sounds in some sort of dodgy way. It's that you can be found by future providers if you need finance. And a prime example of that is a mortgage lender. So somebody in the future, when you then look for a mortgage, they need to know you exist and you reside where you say you are residing. So make sure you are on the electoral roll. The local authority will be able to help with that. You'll be able to check who's registered at your property. Also make sure nobody's registered at your property who doesn't reside there, because they need to be removed if they were a previous owner, a previous tenant, anything like that. And make sure it's just you and partner, family who need to be at that property are registered at that property. It will massively boost your credit score, which moves me on nicely to the next point. Your credit score slash your credit history is exactly what people look for when they want to give you credit. So if you apply for a personal loan, car finance, mortgage, those providers will automatically run a credit check, and they are checking everything you need to be aware of. They want to know, okay, have you had any credit before? Have you got a credit card? Have you got any loans? Have you paid them back on time? Did you miss a payment? Is there anything negative on there? Are you on the electoral roll? And all these little things add up and give you points. The higher you can get on those points, the better your credit history will be. I've popped a couple of links on the screen there that you'll be able to see that show you where you can check your credit history and get your credit file. And Lily is kindly going to share these links at the end as well, so that everyone has access to them if you wanted to go in and have a look at them as well, just to make sure everything on there is correct. There are many a time something has been put on somebody's credit file in error. So again, that's something to bear in mind. I'm going to move on to find your weakness. This is quite a comical one. We live in a world where things are tight money-wise. We are very much in a cost of living crisis. Yet everyone has a weakness. So I'll give you a prime example. One of my members of staff downstairs, we discovered it at Christmas into the new year that her weakness was coffee at Greggs coming into work on a morning. And the reason for that is her bank account very kindly gave her a summary of her spending over the year, and that's when she realized how much she spent in coffee. And it's amazing. Now, bearing in mind, if you came to university in the Northeast, if you are from the Northeast, you'll be well aware of Greggs, and Greggs are not the most expensive coffee provider out there. You know, there are many other more expensive coffee providers out there, Starbucks, Costas, and all of the rest. But, you know, a standard latte in Greggs would be £2.35. If you do that just a few days a week, nothing major, just a couple of pounds here, a couple of pounds there. If you do that 3 days a week over the average working year, you're looking at nearly £400 just on coffee. Is that something you can pull back on? So find your weakness. Do you need to go through your email inbox and unsubscribe from people sending you emails to say there's a sale on, it's got your favorite workout leggings, it's got your favorite handbags, it's got your favorite tech, whatever it might be? If you unsubscribe from those emails, you are not tempted to then look when they land in your inbox. And a big one for me, and I've recommended this a few times, and I know it's not a nice thing because we live in a society where it's so easy to pay on things like this, your mobile phone. You can just go in anywhere, tap it, and you've paid and you move on. If you unlink your Apple Pay, unlink your PayPal, You can't do that anymore. You have to think about actually physically paying in cash or with a card. It takes a little bit more thought process. It stops people spending with no thought for the consequences of that. Another little thing, set a limit on gifts. Some people, I've had this conversation a few times with clients recently over Christmas. You start getting gifts for family members, for friends, and it just gets a little bit out of hand. Can you do a secret Santa with family so everybody only buys one gift? And can you limit the cost of that so it doesn't get out of hand at Christmas and it gets you into a point where you think, I can't afford Christmas presents, and you panic, and then you start putting money on credit cards when you can't afford it. And just become a little bit more of a savvy shopper. Can you take a bank account with one of the online banks, maybe somewhere like Monzo, Chase, things like that give you cash back for every time you spend? Every time you spend money, you might get 2% cash back into your bank account. Become a little bit more savvy in the way that you spend. So make your bank account work for you. Register on the electoral roll, check your credit history, and become a little bit more savvy in where your weaknesses are, and be honest with them. Don't try and pretend that it's okay if you need to save some money. Moving on from that, I'm going to move on to budgeting a little bit, and just looking at some of the basics of budgeting. And it is very basic at this stage. Nothing needs to be too complex. The easiest and most simple way you can look at a budget is start at point number 1. Log what comes into your bank account every month from your income. What do you earn every month? Then make a note of your essential commitments. So that would be rent, mortgage, utilities, all of the things that you have to pay, council tax, things like that. Your broadband at home, mobile phone, everything like that. Right, what is essential? Then start to think about that day-to-day spending. Still essential, you need to buy food. Of course you need to buy food. But do you need to eat out as much? The gym membership, Sky TV, Netflix, all of those things. And start then thinking about, okay, well, I've got my essential. I've got my day-to-day spending that has to happen. But what's the luxury items I want? Do I have a goal to go and buy a nice new car, a luxury car? Do I want to go on that fantastic holiday? Do I want to go 3 holidays a year? Whatever it might be. How much will that work out at, and how much do I need to start thinking of paying for that? Then look at it, review it, and say, okay, where can I cut some money, and where do I need to pull back on things in order to have those luxury items? Everyone is individual, everyone is unique. It's completely and utterly up to you where you want to spend your money. Nobody is saying your spending's right and somebody else's is wrong, or vice versa. But you need to decide if you want to buy those luxury items and you can't quite afford it. You need to think, okay, well, where do I want to not spend that money so I can afford it? And that is ultimately how a budget works. Very basic, but there's your 5-step plan to writing and making a budget, but don't forget to review. Moving on a little bit more now, we're moving on to debt versus saving. Now, I found this lovely little screenshot here, and it was courtesy of one of the big banks out there. So again, I've referenced that at the bottom, but I just wanted to show some of the things you need to consider when you've got some savings or you've still got debt. Which one should we be looking at? It's a question when you leave university that is very, very, very common, or in the years following university. So a couple of easy ways to look at it is you need to look at your debt and you need to think, what are you paying on that debt? If you've got debt on something like a 0% interest-free overdraft, or a credit card that you've switched to a deal that you're not paying interest on, then you're not paying any interest. It's almost classed as good debt because you're not paying anything for it. Excellent, brilliant. We can always look at leaving it where it is. If you are paying I'll give you a prime example, credit card debt, you've got £5,000 sitting on a credit card, but you're paying 20 or 30% APR on it, that's expensive. That's costing you a lot per month. So yeah, you need to start thinking about getting that down. There's also other things to take into consideration. Are you locked into that debt? Is there a penalty to actually pay it back? Things like your credit card and things, there won't be, but personal loans, car finance, sometimes they charge you if you want to repay earlier, and those charges can be quite substantial. So obviously you always have to take those things into consideration as well. And then obviously it goes into, okay, do you have any debt with a low interest rate? Because if it's yes, then actually you could potentially think, okay, well, it's a low interest rate, but could I make more with my savings? Am I making more with my savings? So you need to look at the interest rate that you get on savings. You need to look at the interest rate you're paying on your debt and work out which one's better to have. It's not always a great idea just to save and still have debt in the background. If it's an expensive debt, let's look to clear that first. And let's look to then start saving after that with a little bit more of a clearer head a clearer mind in order to be able to sort of move forward and plan for the future. So it's definitely important to think about it. And this leads nicely to my next slide, which is a little bit of an example of some good debt versus some bad debt. The common misconception in the kind of society that we live in is that debt is bad. And I would have to say I actually disagree with that. Not all debt is bad. If you need to buy a car and you go and you take car finance or personal loan to buy a car, and it's manageable, it's affordable on your income, it gives you the car that you need to be driving around, getting to and from work, whatever it be, then that's fine. That's absolutely no problem with that debt. A prime example is you go and buy a car, and I don't know, I'm making up figures here, but £200 odd a month car payment, fine. If it's doable and manageable, great. I saw a client recently where the car payment was £800 and something a month because it was a big car. Yes, great. This gentleman loved his cars, but actually when we broke it down and looked at their income versus their outgoings, on paper, they couldn't really afford £800 odd a month on a car. It is quite a substantial amount to be paying out for a car. And I hate to be the bearer of bad news in that scenario, but I had to kind of say, well, maybe we could downsize the car a little bit and downgrade all of the car. Instead of having all of the features, could we go for something a little bit cheaper and give them some food for thought? So there is good debt and there is bad debt. Leaving university, a common one to have, and don't feel bad for this, is a student loan. That is very, very normal to leave university with a student loan. I'm going to be honest, it's pretty good debt. It's cheap to pay back. You only pay it back over a certain income. You don't pay it back straight away. Yes, you pay it back for a noticeable length of time, and I understand that. But because it is taking its source off your income, often you don't really notice it coming out because it comes off your pay slip. And it's just one of those things that gets paid, it pays it back. It is actually good debt. You're paying it back over a longer period of time. A mortgage. Take a mortgage to buy a home. Again, it's good debt because most people couldn't buy a home without a mortgage. So that is good debt. So there are differences between your good debt and between your bad debt. So it is just a case of being sensible with that. If there is something you need to take on credit and you need to take a debt to be able to buy something, make sure you shop around. Don't walk into a car sales room and sit down and sign the paperwork because that's what they're recommending. Go and look around. Go online, speak to friends, family, professionals in the field, and see if there's a better deal you can get somewhere else that's actually a little bit cheaper for you. And again, make sure you get the best deal for you. So just some examples there of the difference between kind of good debt and bad debt, because actually not all debt is bad. And also, I wanted to mention at this point, it's an ideal opportunity to mention at this point, that having some debt can work in your favour, which might sound quite strange to some people, I'm aware of that. But I have come across many, many people over my 20 years in this field, when they've gone to apply for their first property, a mortgage on the property, and they've never had any debt before at any point in their life, which is great. They might have a student loan, but that's it. They've never taken a credit card, they've never had a car finance, they've lived within their means, which is fantastic. But actually, you then have a credit check done on you, and the lender has no history of how you are and how you pay things when you need to pay them. Do you pay on time? Do you pay late? Can you manage and handle finances? So having some debt can work in your favour, but it's about keeping that level manageable. So a great thing for this is a credit card. Having a credit card, not only is it great for emergencies, brilliant, but if you can take a credit card and go and put a tank of fuel every month on it, £50, £70, whatever it might be, a supermarket shop, go and buy it, and then pay off your credit card, do it again the next month, pay that amount off, do it again the next month, pay that amount off. You are actually proving to any future lender who looks at your credit file that you can manage money really well. You know how to buy something, but equally, you know to pay it off. So bear that in mind, that actually that can then build your credit score and give you a slightly better credit history for the future. So good debt again versus bad debt. However, if you went and put a tank of fuel on, then the supermarket shop, and then you went shopping, and then you went on a night out, and then you booked a holiday, and you were just paying the minimum payment, that debt rolls up, and yeah, it's fine, you can make the minimum payments, but that's when it falls into that Still manageable, it could be, but it's classed as more of a bad debt because actually you've got potentially hundreds into thousands of pounds to pay back to a provider, and you haven't got enough income to coming in to pay that back unless you pay it back over a really long period of time. So again, just bear that in mind. I wanted to share a little tool with you, about savings. So on the next screen, I've got that to come, and you can log on and do a little bit of savings tips. But I wanted to cover first how to start saving, something I get asked lots, especially by younger people, perhaps starting out from university, the first professional job, a graduate saying, like, where do I start now? I've got a regular income coming in, that's great. But the tendency is in the first couple of months, I've got this regular income coming in, fantastic, I'm going to go out and spend all this money because I've got it and I've never had it before. And then you start to think, I might want to actually start to save. And how do I start that? And where do I start? So starting good habits early are always going to help you in the long term. Start small. The amount of people who say to me, right, I'm going to start saving £1,000 a month, and you think that's way too much straight away. Let's start small. Can you aim to save £50 a month, £100 a month, whatever it is? Again, go back to your budget, see what you've got to spare, and say, right, I can actually save that. I can skip the daily coffee or the daily lunch or whatever it might be, and I can put that to one side. But start small, be consistent, and be regular. If it helps, on the day you get your salary paid into your bank account, have a standing order come out the following day into a savings account. It's gone. It's not in your bank account anymore. It's separate. You don't need to think about it. If the money's sitting in your current account, the tendency is, again, not with everybody, and I'm aware it's a stereotype, but all of the bank accounts that I've seen over here, the tendency is if it sits in your current account, you think you've got money and it's easier to spend because it's there. If it's separate, it's not as easy to access. It's not as easy to spend. Open a savings account. Most bank accounts you can link a savings account to it directly. So when you log on to your online banking, obviously on a PC, your laptop, or on your phone, whatever it might be, you can see them. Current account here, savings account there, and you can see the money going between. And it gives you a nice positive feeling. It builds those endorphins when you see the savings increasing. Great. There are obviously longer term savings you can look at, and it all depends on what you're looking at over the future. I'll touch a little bit on that nearer the end of the presentation. But a simple thing to start with is a nice savings account with your bank account. A common one at the minute is save the change. Lots and lots of bank accounts do this now. So if you go and pay for something and it's £10.84, they will round it up to £11, and the change, the difference, will pop in your savings account. It's small, but those small things add up. As the saying goes, and the slogan goes for one of the main supermarkets is every little helps, and every little does help. It adds up, and those little things add up over time, and you don't really notice 10p here, 20p here, 30p there, but they all add up. So save the change is a real popular one at the moment, and people do like it. And I know a couple of people do the save the change purely for holidays and extra luxuries. Great. Move your money. Look to make sure that your money's working for you. So going back to what I just mentioned before a little bit about a savings account is great, but actually if you are getting to the point where it's a substantial amount in there, it's actually probably not good. It's not worthwhile you leaving it in there because you're probably not making that much with your bank. And that's where it's sensible to move it somewhere. Do you need to move it into an ISA? Do you need to move it into an investment? Depends on what your long-term goals are. So this is not a one-size-fits-all, but you need to look at making sure that your savings work for you. There's a really helpful website there that compares everything you need to know about bank accounts, about savings accounts, about accounts that you can lock the money away for a year, maybe 2 years, and who pays the most in interest for that. So if you know you've got £10,000 you are definitely not going to need for the next year, don't leave it in a savings account. Move it to a fixed interest account for a year, lock it away. It means you can't get access to it without paying a penalty, but you get higher interest on it. It just gives you the little bit more interest. You will make more money from it. And ultimately, we all want to make money on our savings. So it's an added bonus. The other thing you can now do, which I'll be honest, were not around when I left university, apps. There's a million apps out there, but I've listed some of the big ones. And these apps link in or can link in to your bank accounts. They can look at your spending habits. Again, very scary. They can look at how much you're saving, and they can help you to budget. A couple of them do use artificial intelligence to look at how they predict your spending over the coming months and where you can potentially then save with that spending? Can we not spend it here? Can we move it here? And they're really, really helpful. Again, they're very visual. They give you lots and lots of tips, and it boosts your endorphins when you see that you're making a real difference if you log in every month and you can see your savings accounts increasing. So utilize them. A lot of them are free, or you get a free trial. Some of them $2.99, $4.99 to buy. They're not expensive to start with, but if they help you massively in the long run, use the tools that are there to make things easier for you. That's what they are there for. The other thing you can do is take a savings challenge. Now, this can be on one of those apps, or indeed, I've known people do it amongst family members, friends, do it with a partner, whatever it would be. Challenge yourself to say, okay, by the end of 2024, I'm going to have X amount put away because I really want to go on a holiday next year, or I really want to buy a house in 2025, or move house in 2025, whatever it would be. But can you make yourself a little challenge and even reward yourself if you get there? It doesn't have to be something that's going to cost money for a reward. It could be something that you don't do enough of to give yourself a little bit of breathing space and mindfulness. So again, if you give yourself rewards and set yourself the challenges, it encourages you to work towards them along the way as well. And a real popular one at the moment, and one that I've known a few people make some really good money from, is look around and sell unwanted items that you might not need anymore. You might think nobody wants to buy it, but I think you'd be very surprised. There are so many websites out there to sell things, Facebook Marketplace, Vinted for clothes. I have a young daughter, she's 8 years old. We recently sold a lot of her old toys. She was getting to the age where she didn't need some of them, and we had a discussion with her that whatever we made, she could have. And I was pleasantly surprised at how much she made. And she thought it was great because then she could go buy some new things that she wanted, or put them towards what was important to her now. Can you sell things? A lot of things still have a lot of life in them. And it's great because we don't want to live in a throwaway society. It helps to recycle things and let things go to a home where they're going to be loved just as much. But again, it's a great way to build on savings and build that budget. So again, look at selling some unwanted items. What's old and not needed to you might not be to the next person. So bear that in mind as well. You'll see here just a simple savings calculator, nothing major. It's just to keep you right as to where you are. Really, really simple. And the website, again, will come out at the end. Lily will send it to you because you can go in and you can have a little play around with this. It's a live website link. How much do you want to save? When do you need it by? How much do you already have? What's your average interest rate if you look across different savings accounts? And how much will it work out? So this is really helpful. And it's a really good thing to be able to do to give you those challenges and those goals that I alluded to in the previous slides. So please do utilize some tools out there. As I mentioned at the start, Google can be a minefield, but there are some useful things out there as well. So use those useful things. Just don't get bogged down too much with reading blogs about how someone did this and how someone did that, because remember, their goals might not be the same as your goals long term. I'm going to move on and discuss a little bit about how all of that ties into getting a mortgage and potentially buying your first or subsequent properties. Because a lot of people see a mortgage as something to aim for, absolutely great, and it definitely is, but also they can be quite scary and a little bit daunting, especially if you've never done it before. As Lily mentioned at the start, I've been an independent mortgage advisor now for 20 years. When I get to September this year, it's a little bit scary because I do not feel old enough to have been doing it that long, if I'm being honest. But I've seen mortgages go through recessions, pandemics, Brexit, wars, everything else, you name it. I've been through it in the last 20 years. So I've definitely seen the mortgage market thrive, and I've also seen it very, very, very quiet and very, very, very much in a bad place. So there are pros and cons of taking a mortgage at a certain time, and to be honest, the argument could be there's never a right time. The mortgage market itself has been very, very turbulent in the last 12 months, with interest rates constantly rising. And it's at this stage I would always say, you know, if you want to look at a mortgage seriously, really think about speaking to an expert. If it's not me, that's fine. There's plenty of other advisors out there who can help you. I'll give you a prime example. If you needed to fix some electrics in your home, most of the time people don't attempt to do that themselves in case they electrocute themselves. Why at that point would you try and do it yourself? You would pay and bring in an electrician. Exactly the same with mortgages. Don't try and do it yourself by finding an article on Google. Bring in an expert, somebody who deals with it day in, day out, who can give you options you didn't know existed, who can help you take you through each step and hold your hand throughout that process. That's what a mortgage advisor does. So I wanted to touch on some of the basics of mortgages, a couple of things that people aren't aware of maybe. It might be going over some stuff you're aware of, but hopefully you'll pick up something. Lily did mention to me in advance that there had been some questions submitted for today's presentation in advance of the presentation. And I'm hoping that this section will answer a few of those because there was some common themes coming out on them. So the simplest way to describe a mortgage is it's just a really, really big loan. And the reason it's called a mortgage is because it's secured against your property, be that a house, a flat, a bungalow, whatever it might be. And the mortgage lender is lending you money, but they are using your property as collateral for that loan. And that's ultimately it. It's called a mortgage because you spread the payment out over a really long period of time. The reason you spread that out over a long period of time is because ultimately you're borrowing quite a substantial, normally, chunk of money. You have to then pay it back over a longer period of time to make it affordable to you. So you provide a deposit, the mortgage lender provides the mortgage. And between your deposit and the mortgage, you buy the property and you go forward and you are the homeowner of that property. You can choose, there's so many options with a mortgage, a lot of the options that people aren't aware of. You can choose the length of time to borrow the money over. I've written on the slides there, is the 25-year mortgage term a thing of the past? And my answer would be absolutely, it totally is. If you speak to older generations, when they took mortgages, everybody took a mortgage for 25 years because that was all that was on offer. I'll be honest and say that is extremely rare these days, especially on your first purchase. You can take the money that you borrow over any period of time that suits you, as long as you can afford to pay it back. You might want to take it over 10 years, great, but if that gives you a monthly payment that you can't physically afford, then you can't take it over 10 years. It could be 15, 20, 25, 30, 35. Obviously, there's parameters that come into it like age, planned retirement age, what the lender parameters are, but you've got lots and lots of flexibility and lots of options to look at when you do take a mortgage. I think the only thing that you've got to bear in mind is the majority of lenders need you to take that mortgage over a full year. So it can't be 26 and a half years. Most of them want 26 years or 27 years, but it can be anything from 21, 22, 23, on it goes up to 35 or even 40 with some lenders as well. The longer you borrow the money over, the slightly cheaper it is per month, but naturally you pay a little bit more interest. So it's always about getting that balance right and looking at options, which is exactly where an advisor can come in. Lenders do have strict affordability criteria when they look at income and expenditure. They will want to scrutinise your bank accounts, which sounds really invasive, and I'm aware of that, but they will look through your bank accounts. Most lenders will, on average, look at the last 3 months' bank accounts. So again, thinking back to what I said at the start, can you tidy up your bank accounts? Can you make them look a little bit better? I'll give you a prime example. No lender wants to see gambling on a bank account. They don't want to see people spending money on paddy power every 2 days. They don't like that. So can you make it so that you don't do that over a period of time, or try and stop going forward? Actually make your bank accounts look better. Can you get yourself into a positive balance every month? Can you make sure you're not overdrawn, not drifting into the overdraft of just a little bit because you wanted a night out with some friends? Can you keep yourself in that positive balance rather than being overdrawn? So it's lots and lots of things you can bear in mind about looking at your bank account, because it does feed into affordability. Lenders will take your income, but they'll also look at expenditure, and they want to see what they think will be affordable, even if you think something else is affordable. It doesn't matter. It's the mortgage lenders' rules that tend to apply rather than your rules, unfortunately. Going back to that initial credit check, can we close down all old accounts? This is a really common one. Many people say to me, and I say, have you got any credit cards? Oh yeah, but I've had them years and I don't use them. If you don't use them, close them. Don't have them. Because what a lender sees is the capacity to lend. So if you've got 4 credit card accounts, each with an option to go out and spend £5,000 on them, you might say, oh, well, I won't do it. But what a lender sees is that tomorrow you could go out and spend £20,000 on furniture, holidays, cars, and all of a sudden you're £20,000 in debt. So your capacity to lend is large. Can you close those accounts down? And then it won't show, and your capacity to lend is reduced. you become a better risk to the lender. So it's all about bearing in mind little things that will help going forward and things that will help you to be able to obtain a mortgage going forward as well. I wanted to also highlight, if one lender says no, it doesn't mean they all will. Many a time I get a referral from existing clients to somebody else, friends, family members, where someone maybe has gone down the high street and walked into their normal bank, NatWest, Barclays, Halifax, whoever it might be, and they've gone through the mortgage appointment, they've gone through everything and they've been declined, and then they panic. And actually, just because one lender says no, it doesn't mean another one will say no either. Many will say yes. Every single mortgage lender out there will have their own criteria, and they will have their own niche market they are aiming at. If you're not their market, don't panic, because you probably will be somebody else's. And it's about knowing where to go and depending on what it is that you're looking for. So remember, there's always options beyond the high street, is what I'm saying. And many of those options beyond the high street often are better than those high street options as well. And the last thing on this slide, just compare options. Like I said, always try and speak to an advisor, somebody who does this day in and day out, who's a specialist in this field. Don't try and be the electrician on your mortgages, because unless you're qualified, you won't necessarily know what you're talking about. And the best bit of advice I can give is, just because a friend or family member's had a mortgage, it does not make them an expert. Many a person will try and tell you how you should handle your finances and your mortgage because that's the way that they do it. Just because it's the way that they do it, it doesn't mean it's right for you. And that's the same with parents, cousins, aunts, uncles. Remember, this is your finances. This is your future that you need to be planning for, nobody else's. The last screen I wanted to kind of touch on today was something that goes alongside mortgages. And to be honest, they go hand in hand together. And I wouldn't be doing my job if I didn't discuss this with clients when I go through it. When you take the likes of a mortgage, you are taking, for most people, the biggest, going through the biggest financial transaction you'll ever go through in your life. And you are taking the biggest debt you'll probably ever take against you in your life. You need to be prepared that if something goes wrong in the future, you can still maintain that debt and maintain that mortgage. So that could be making sure that your income is secure. Do you have a job that pays you if you are off work due to accident or sickness? How long do they pay you? What happens when they stop paying you and you're still off work? Do you have a protection policy in place that actually would cover some income going forward into the future? What happens if you get ill and you can't work long term? What if you're critically ill? What if the worst happens and you or your partner or a family member, somebody was to die? You don't want to move out of the home. Are you covered for that? So there's lots of things to bear in mind on this slide, and I don't want to go too far into it because there are so many options out there. But what I do want to make you aware of is, when you start thinking about budgeting, especially buying your first home or a subsequent home, don't always think about the mortgage budget being the top end of everything. Bearing in mind, you should be allowing a budget not only for essential expenditure, council tax, gas, water, electric, and all those sorts of things. You should be allowing a budget for protecting yourself if the worst were to happen, because you want to be able to sleep at night and know that everything is fine if the worst were to happen. There is a scary statistic in the UK that more people pay to insure their pets than they do their husbands/wives. So bear that in mind. Most people are bothered about the vet's bill than they are about their partner dying. And that is a scary statistic. It doesn't necessarily mean that you have to spend lots of money on it, but protection is always something that should go hand in hand with a mortgage. And you should always think about it as one transaction as opposed to two separate transactions when it comes to budgeting. And I never want to leave that off, because too many people think about it retrospectively and then go, well, I can't really afford it. So always bear in mind the protection. You want to protect your home, your family, and potentially your income. They are the most important things, and they keep that roof over your head at the end of the day. And to finish today, I'm aware it has very much been a whistle-stop tour. I think timing-wise, when I look at the clock, I'm doing okay for time, and we've got time for some Q&As. But because of that, I am aware that we haven't gone into a massive amount of detail on anything, and I could talk about this for hours. But to finish today, I wanted to finish with a quote that I always kind of go back to. You can only do three things with money. You can save it, you can spend it, or you can give it away. Somehow, over the course of everything, we've made everything really, really complicated. And actually, take it back a step and take it to the basics. When you earn your money, do you want to save it, spend it, or gift it? And that could be in the way of charitable giving or gifting to somebody else. But be sensible, because it's your money. And think about what you want to achieve in the next 5, 10, 15, 20 years, and on it goes from there. And that's the sort of thing to think about. So that's what I wanted to finish with today. I'd like to thank everyone for listening for the last 40 minutes. I hope that you've brought a little nugget of information from the presentation. Maybe it's given you some food for thought about how you manage your finances. Maybe it's given you some pointers to go away and think, actually, I'm going to download that app and I'm going to be a little bit more sensible, and I can reduce my spending here. I can reduce buying lunch when I'm in the office, or coffees on the way to work. Whatever your weakness is, make sure you try and pick it out. Most people have one. We just don't like to admit we've got them. And hopefully it's something that you can take forward and improve your finances going into 2024. We've got a question and answer session coming up, so I hope all of this works really well. I'm going to stop sharing my screen now, and hopefully you can see Lily and I, and we can answer some of those questions that have came through.
Amazing. Thank you so much, Lyndsey. That was super informative, and I can definitely, from personal experience, vouch for some of those sort of quick wins that you were discussing. Yeah, in terms of the cleaning up your bank account and all that sort of stuff, it absolutely, definitely helps. And it's those little things that really count, and just having a look, and I think being honest with yourself about what's essential versus what's
Very
not
much.
essential.
It's amazing how a daily coffee becomes essential.
Yeah, it's funny that you mentioned the Greggs thing as well, because I had a very similar ex-colleague, but hers was McDonald's coffee, not Greggs.
Yeah, I had to mention that because my office is just outside of Newcastle, and there's a Greggs just a couple of minutes walk from here. And it's becoming a little bit of a regular occurrence that I see a Greggs coffee cup on a couple of people's desks every day. And I think, oh, that's an expensive habit to get into.
It is. It is,
Yeah.
absolutely. So yeah, absolutely, the little things, it's absolutely, you just need to look at what is essential and non-essential.
Yeah, absolutely.
So as obviously Lyndsey mentioned, everyone who's still on the call, we are going to have sort of 15 minutes roughly for Q&A. So if you've got any questions that you want to ask Lyndsey, well, we've got her here about anything she's covered today. If you wanted to go into a bit more detail into any of the topics, please feel free to share those in the Q&A or in the chat function. We did have some pre-submitted questions to this, which I think majority have been covered in Lyndsey's presentation, so thank you for that. There were a couple though that I just wanted to raise, Lyndsey, if that's okay with
Absolutely,
you.
fire away.
So I think we've had the same question in the Q&A live as we had in the pre-submitted questions, and it's from one of our international students. And just a quick question around sort of if you are a residency permit holder, or someone who's not a UK citizen, or that just here studying or working, how could they improve their credit score?
Credit score and credit history. Yes. Yeah, it's a one that I come across quite a lot, and it is a really sensible question, because actually the earlier you can think about things when you move to this country, the better you can be going forward. I think anyone who's coming in internationally, if you can help by opening a UK bank account, that's the first port of call. I would say definitely try and get a UK bank account, get a permanent address, get yourself registered on the electoral roll, things like that. Obviously, I'm aware that it depends on where you're coming from. There's obviously different rules on visas and entry systems and permits and things like that. But if you can do little things to start building a credit history in this country, that will help you moving forward. But the biggest thing I would say, especially if further down the line, if you wanted to come to look at things like mortgages and apply to actually live here permanently, what we need essentially is ideally 3 years address history. The majority of lenders want 3 years UK address history. We can do it occasionally with a little bit less than that, but it's not always as straightforward as it would be if you had 3 years registered address history in this country. So as soon as you can get yourself into property a bit more permanent, even if it's rented, then get yourself on that electoral roll. Make sure you have some utility bills in your name, because again, that's just shown that you are residing at that property. Try and get yourself that bank account. And then once you've been here a while, there will be a possibility for you to be able to open a credit card. Again, we don't want to get to a credit card where you're building up debt, but if you can get a credit card open and buy one thing, pay it off, buy one thing, pay it off, then that's naturally going to build that credit score, because you're starting from scratch literally from the time you arrive here. So hopefully that will help. But don't ever think, if you are an international student or graduate, that you can't then move forward and be able to get a mortgage in the future, because you definitely can.
Brilliant, thank you. Just going to, we've had 2 questions come in so far in the Q&A, so just want to cover those if that's all right.
Yeah, absolutely.
So the first one is going back to that umbrella section that you had that was talking about all the different sort of types of protection you should think about and have in place when you get a mortgage. And someone's just asked if you could clarify what's meant by the contents bit under that umbrella.
Sure, absolutely. So that's basically that's protecting the contents of your home. So if you own a property, most people obviously want to protect what's in that property. So most people have buildings insurance as standard, mainly because that is the only compulsory insurance in the UK. Nothing else is compulsory. Everything else is just optional and sensible planning. But in order to get a mortgage, that mortgage lender will want you to insure the building. So they'll want you to insure your flat, your home, your bungalow, whatever it might be. And that's the buildings. Your contents are everything inside it. I have a little analogy where I say, imagine if you've got a home, even if you're renting at the minute, this is still relevant because it's the contents in your rental property. Imagine taking a hold of that property, turning it upside down, giving it a good little shake, and everything that falls out is contents. That's your contents. So that covers everything from obviously your contents of your wardrobe, clothing, cosmetics, but it also covers televisions, sofas, kitchen equipment. I've had so many conversations where people say, oh, I don't insure my contents, I hardly own anything. If I went round their home, it is easily thousands upon thousands, because if you had to think about just replacing the contents of a kitchen alone with pans and cutlery and plates and even the basic crockery to get by, it's a lot of money. Then start on things like a wardrobe, when you're taking into consideration everything from belts to socks to underwear to clothing, coats, shoes, trainers. Again, it adds up. And people regularly, it's a common one, I'll be honest, with students. They don't insure their contents because they think, I've got nothing worth value, but actually they've probably got, iPads, laptops and everything else. So imagine tipping that property upside down, giving a shake, everything that falls out is contents. So that's your contents insurance. If you're renting, I would strongly advise you look at a contents provider that can provide some insurance to cover you if you are something happens, if you're burgled and something is stolen, or indeed if there's a partial fire or something gets damaged accidentally by spilling a tin of paint on a TV, anything like that, and covering your contents. But if you're buying a home, often you can take your buildings insurance together with your contents insurance and do it as one policy. It's a little bit more cost effective. And I hope that answered the question for the contents for that person.
Perfect, thank you. The next question's just going back to thinking about credit cards, Lyndsey, and is there any sort of comparison sites or similar websites that you'd personally recommend for looking at credit cards specifically?
Yeah, absolutely. That little Money Compare website that I was said that you'd share, that's got some stuff on there as well about different credit cards. Again, if you wanted to get a credit card to be sensible with it, great. Think about what you want in that credit card. It's a bit like your bank account. You want it to work for you. If you've got a bank account, you can go, most banks tend to offer a credit card often to their existing customers, but if it doesn't give you anything, then why have it? So I'll give you some really good examples. They might not suit you. Again, look into it, but some good examples are the likes of your John Lewis credit cards, because you collect points and then you get John Lewis vouchers. So then you go and shop for them in John Lewis. Personally, I have a John Lewis credit card. I build all the vouchers up all year, and then I buy some Christmas presents with it, because then it feels like it's not as expensive at Christmas. The other thing is you can get one that builds up sort of air miles if you're a frequent traveller, where you get lounge access, or you get something back on that. Again, cashback credit cards. So always try and look at something that gives you something for spending with them, because ultimately then it's working in your favor and you're getting something from that. So yeah, that little Money Compare website that will be shared with you. The other one, and I'll be honest, and I think Lily, you and I touched on this in a previous conversation, I'm not a massive fan of the actual website. I think it's very busy, but Martin Lewis has a money saving expert website. It's extremely busy. There's so much content in there, and Martin Lewis, like him all over me, has a great idea of what he's trying to achieve, and he does get some great messages out there, but he very much throws everything at that website, I feel, and it's a bit whoa, but it does have a section on credit cards, and again, have a look on there, because it has the best kind of credit cards for cashback, the best vouchers, and again, have a little look on there. That should help.
Well, thank you. We haven't had any more questions in the chat, but I have got one from the pre-submitted questions, Lyndsey, that I'd like to ask.
Sure.
It's okay. This might be our final question, or we might be able to squeeze in one more. So if anyone on the call still has questions they want to ask, if you can get them in now, that would be great. I guess this one's a little bit about sort of bit of motivation, bit of advice. So for someone who's in a situation where they're looking to save for a house, but they don't have currently any money saved, you know, they're not looking to inherit any from family.
Yeah.
So they're kind of, you know, at sort of the starting point. I guess what's the sort of best advice in that situation when, you know, saving for a house deposit, which, you know, as we know, house prices are really high currently. Yeah, what advice would you give to somebody in that sort of situation when it can feel like quite a mammoth task?
The first thing I would say is it feels massive at that stage. It really does. And you often think you're alone, and I can assure you, you're definitely not alone. It's a common problem. You think, I want to buy a house, but it just feels absolutely massive to me at this stage. So going back to what I shared in those slides, start small. Don't try and set yourself a target of a ridiculous amount per month, because you'll just not stick to it. Start with a small amount and start getting used to putting that away, and see if you can increase that in the future going forward. And then start to make that money work for you. If you are specifically looking to buy a property and that's what your savings are for, then there's the likes of your lifetime ISAs out there. There was the Help to Buy ISAs, but unless you've already got one, you can't open those now. So your lifetime ISAs, start putting them away into a scheme that you get something back from. So the government do give you a bonus on a lifetime ISA, and they are meant very much to purchase a property with. So again, it has parameters. You can't just take that money back out if you fancy buying a car. So you've got to be aware of, you know, what your future goals are. But start saving in there, because for every pound you save, the government give you some money back. So you can build it up over a period of time. So again, that's free money. And as awful as it is, and it seems like this mammoth task, and it feels massive, if you sit down and write a plan, it's amazing what you can achieve when you've got a plan. So I'll give you a prime example. I saw a client of mine, it'll be about a year and a half ago now, young couple, that sort of level, and they just thought it was massive. And when we wrote a plan together and said, look, this is what you do, they then got in touch with me just before Christmas. They went away, and unbelievable what they'd saved in that sort of just less than 18 months, because they just literally said, we need to be sensible and cut out everything we don't need. And yes, they said it's not been the most exciting 18 months of their life. They hadn't been away much or done anything, but they didn't buy each other a Christmas present. They didn't buy each other a birthday present. They put that money they would have spent in that pot. They didn't go and eat out that often. You know, when they did, occasionally it was more, you know, a cheap and cheerful pizza as opposed to a posh, expensive meal, which they were in the habit of doing. So, and it's amazing. And they said you couldn't believe it, how much the pennies and the pounds started to build up. And then they started to get those endorphins from seeing it, and that positive affirmation from seeing it. Then it makes you want to put more in it. And then they got the gentleman actually got a second job, because he was like, I can see this happening. And you know, and it just made them feel positive. So it does feel really daunting. I'm fully aware of that, and it's not easy for everybody. You know, not a lot of people don't have the bank of mum and dad to help, or inheritance coming their way, and they've got to work really hard for it. But all I would say is you can do it, but start small and set yourself some targets.
Perfect. Thank you so much. We are probably going to close the session now, so I'm sorry if I've missed anybody's questions, but we are coming to the end of today. We've run out of time, so I am really sorry if anyone has got any final questions, but hopefully today's session has been informative. We've had, Lyndsey, lots of comments in the chat thanking you for such an informative session. I think you might get some inquiries after this for some mortgage advice as well, which is really nice.
Always here to help.
So in terms of, you know, massive thank you, Lyndsey, for coming today and delivering this, and a massive thank you to everyone who's took their time to attend today, you know, wherever you might be in the world, and we really hope that you enjoyed today's event. In terms of Newcastle Discover, the events will return in April, but before that, next up in our sort of engagement programme schedule, we'd like you to all get involved in our upcoming NCL in Action programme. For those of you who aren't aware, NCL in Action is our annual university-wide initiative that invites staff, students and alumni of Newcastle to take action on a societal issue. Each year we focus on a specific topic, and this year we are looking at raising aspirations. We're hosting a launch day at St James's Park on Friday the 1st of March, consisting of a keynote speaker and an interactive showcase debate on whether education is the best tool for reaching your potential. If you can't join us on the launch day, don't worry, because there's plenty more activities and volunteering opportunities available to you all to get involved with across the month of March. You can find out full information about NCL in action this year on our website, or please do get in touch with myself or one of the team to find out more. As always, in general, if you're interested in finding out more information about our alumni here at Newcastle, please visit our website or drop us an email and get in touch. As a final thank you, I'd like to say thanks again, Lyndsey, for coming on and delivering today's session and taking time out of your very busy schedule.
My pleasure.
And a massive thank you to everyone else. Enjoy the rest of your day, and we can't wait to see you all at another event very soon.
Thanks, Lily.
Thank you.